Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. We'll take a look at the market trade after Tuesday's session close. We saw a fairly mixed day. Quarter wheat found some strength off of Monday's selling pressure. Soybeans, though, couldn't hold on to that strength on the day Tuesday. Livestock trade mostly lower. We're going to discuss it all. We're going to bring in our good friend Jim McCormick with agmarket.net joining us today here on Market Talk. Jim, good to catch up with you, sir. And I know it was before the new year, before we got to talk. So I wish you a happy new year. Thanks for being on the show.
Oh, good afternoon, Jesse, and thanks for having me on. A lot to talk about today, a lot of volatility. We're kind of in the winter doldrums here in Chicago. They're talking chances of snow tonight. I know there's big storms coming across parts of central Illinois and Indiana, but we are in the midst of a major summer weather market in South America, and that's definitely having a big impact on our markets here the last couple of days.
It definitely is. It definitely is. That South American weather, we knew it was going to come into focus as a big topic, and it sure has here the last couple of days, Jim. And I think to start, this soybean complex, it seems like that's the one that has most folks in the trade worried right now. We weren't able to hold on to the strength on the day Tuesday that quarter wheat we're able to hold on to. Argentina weather seems to be improving a bit, although that crop in rough shape. But this soybean complex, it's got that eerie feeling to it that maybe the downside pressure could start to come in more and more here. So what's your thoughts with soybeans right now as you look at this market here after the first couple of sessions this week?
Well, right now, I think you're kind of in a classic weather market at this point in time. I mean, we've put a lot of beans have really surged higher. A lot of it's on the strength of the meal. The reason why meal leads us group is because Argentina is one of the biggest meal producers in the world. If Argentina has a small crop, they're not going to get as much meal out of the country, and that meal demand is going to come to the United States. And with this dryness issues they've been fighting up until recently, we've brought a lot of day traders and fund investor, just pure spec money into our markets. The meal position, Jesse, right now, according to CFTC report, is the largest meal position ever carried by the funds. And the beans are not at the largest position ever, but they are at the highest we've seen in the past 9 months. So the reality of this is a quite crowded trade by the longs, and we're starting to see an atmospheric change in South America. Argentina has started getting some rain over this past weekend. That's why the market broke coming out of the weekend so hard. And now we're seeing a little bit more pressure today, ignoring the bounce on the corn and wheat because there is more rain on the way over the next 10 days. Now, the damage is done on some of this crop, but some of this crop has just been recently planted. So the reality is it will have helped some of this crop. And at a worst case, it has stabilized the crop. So the fuel to the market has been every day the crops is getting smaller. That brought buyers into the market. So Jesse, as just this rain talk that is stabilizing the crop, which is limiting the buyers, and what's making everybody nervous, including myself, is will this be enough to chase the funds out, especially in this meal market? The meal market traditionally is a relatively small market compared to like the bean complex, the wheat complex, and the corn complex. So if we start seeing an aggressive liquidation by the speculators out of this meal due to the fact they say, hey, the party's over, ring the bell, this crop's not getting any smaller, and they run for the exit, you could see a pretty hard, dramatic down couple days, and that's what's got the trades a little bit nervous right now.
Well, and thinking about that, if we see that exodus in the meal market, what in soybeans, what are we thinking downside targets here? Maybe not necessarily as much old crop. I guess I'll ask you that, old crop and new crop. Are there any gaps you're seeing on the chart we need to go fill? I mean, what's maybe some of those downside targets if we see some of that exodus here out of the meal market, Jim?
Well, you're looking at some of the winter lows, but I think like on the November bean chart, there's a gap, I believe, somewhere right around 1292, I believe, off the top of my head, is somewhere in that zone. That's kind of the worst case scenario. Now, I don't think they're going to go there right away, Jesse, but I think it will be a stair step down. I mean, what's going to pretty much happen, folks, is you're going to start seeing the market start looking at the crop getting better in Argentina. And then they're going to weigh it off the crop size in Brazil, which right now, by most accounts, it is going to be one of the biggest crop ever. Now, Brazil's just started harvesting this crop. It's a little bit delayed coming out. But as this crop starts getting harvested and starts moving to the market, this export demand that we've seen recently is probably going to dry up. So the combination of you got smaller exports with more competition from Brazil, the emotional trade being over with in the Argentina, you could see this market work its way a little bit lower. Then we'll see what the acreage battle looks like at the end of March. And then as we see how that plays out, then you're just going to potentially stair step yourself lower as the market gets more and more comfortable where the world supply is.
You brought up that acreage battle, and I think that is something very interesting that we got to keep in mind here, even at the end of January, Jim. I know there's been a few different surveys out. A recent one, Farm Futures, talked about that acreage battle. I know there's talk corn around 90.5 million acres, soybeans around 88.9, maybe more wheat acres just because it takes less nitrogen. So thinking about that acreage battle shaping up here in the U.S. on top of everything else, I feel like that's an underlying story in these grain markets as a whole, Jim, that's really, really going to start picking up steam. If it hasn't already, it's going to in the next couple of weeks.
Oh, there's no doubt about it. And I think it is picking up steam, because people like ourselves are starting to run these balance sheets right now. Now, granted, we'll get the first government's outlook in February, and that's just more of a general, call it just a kind of a general synopsis. We don't get the actual new crop balance sheet till May. But a lot of people are talking 88 million acres, 89. Now, just, what makes us, let's start with beans just to begin with. 88 million acres. If for some reason we end up with a 50 bushel national trend yield with 88, you don't see a major demand adjustment, your carryout's actually going to get smaller than this 210 carryout we have right now. And that's why you can't get incredibly bearish beans just yet, because we don't know where it's going to be. On the other hand, you plant 88 million acres and we manage to have a 51.5, 52 national trend yield, because La Nina is fading and we have good crops. Then you're looking at carryout go the other way, and you're looking at beans probably trading closer to 12 by the fall potentially. So that's where we're at. The corn situation is the exact same way. You're looking at 91.5 million acres of corn. If you end up with a trend yield of 181, 182, you're looking at a carryout, folks, pushing 2 billion plus unless you get a massive rebound in demand, which typically doesn't happen. Normally prices have got to go down big supplies to stimulate that demand. So you're probably going to see this corn market work its way closer to 5 with 92 million acres and trend plus yields. Now, if we for some reason stumble and your yields drought, then this tight balance sheet we have intact right now, that will be a little bit supportive. So there's a lot of water to go under this bridge of where these prices are going to be. But if you're a producer out there, I think you've got to take, I'm going to argue, you got to probably take a glass half empty type of viewpoint of these markets. The weather patterns are changing. Like I mentioned earlier, we've got moisture coming across the Ohio River Valley. We've got moisture coming in a part of the plains. California's getting shellacked with water. So we're seeing these atmospheric changes. Our weather guys are telling us La Nina is dying and we're going to go more into a neutral type of situation. And that potentially sets us up for trend plus yields. And we haven't had trend plus yields. And the worst case scenario for the American producer is we have trend yields following a record crop out of Brazil. And it's just hard to be bullish prices here, even with beans at 13.50. They were just near 14 just a few days ago. But like I said, I think they could be closer to 12 with a good crop. And I think new crop corn could be closer to 5. So there is some downward risk. And then you throw in the economy, which I tell you, I don't know which way it's going to go, Jesse. I don't know if we're going to have a recession, a soft recession, a non-recession. But I think you got to take, if you look at the general trend, the Fed's raising interest rates, people are being laid off. That's not bullish traditionally. So I think that's the other reason why you got to look at the economy a little bit of glass half empty and, prepare for some weakness.
Well, and two, with the economic point of view as well, with the debt ceiling being hit and all the issues in DC over that, and just, what would happen if something's not resolved there and we have any sort of default, or if our credit rating gets lowered in the U.S., what impact does that have on the dollar, which in turn has an impact on commodities, exports, et cetera. So you're exactly right. That whole economic picture, that's just another piece to this giant puzzle right now, Jim.
Well, it's a huge piece right now. I mean, the reality is this dollar, a lot of people believe the dollar is going to start firming up. If the dollar firms up, that makes our exports a little bit less competitive. When you look at what happened the last time we had this debt ceiling crisis under the Obama administration, and when you had a divided Congress, and it got pretty nasty, and it really shook the world's confidence. Our U.S. national debt was actually down, credit rating was downgraded for the first time ever. The stock market took a pretty good hit. And, you say, well, what does that mean to me? Well, the stock market takes a hit. Is that going to affect demand for livestock? Is that going to affect the demand for people going out to eat? If people feel fiscally unsecure, they tend not to spend money. They tend to rein in their spending. And that just trickles all the way down to the farm sector. So it is something we really need to be concerned about. And that's just one more reason why we're encouraging people, to take a really, really serious look at your break evens this year. Because like I like to remind people, the market does not guarantee you a profit. 95% of the people trading commodities are trading to make money for themselves, not to make money for the producer. So you've got to be the one who takes that effort, takes that step forward and says, I'm going to make sure I have that profit margin locked in, because the uncertainty in 2023 is probably some of the highest we've seen in probably 20, 25 years, potentially, when you figure the cost of money involved.
Jim McCormick with agmarket.net is our guest here today on the show. And Jim, let's talk a little more on this corn market. Feels like corn market's maybe in a little better shape than soybeans. And looking at the close on Tuesday, fairly decent close, a little spreading between old and new crop there, it looked like. But I believe March got back above its 100-day moving average. I'm not sure. I'll have to pull that up. Just your thoughts on this corn market a little bit more. Obviously, you touched on a few factors already when talking soybeans, but it, to me, feels like corn's in a little better shape, at least here in the near term.
It is in better shape. I mean, on the beans, you've got the story that fed it was the dry weather. The other thing is you've got the bean demand shifting away from the United States to Brazil traditionally. The good news about that is when we lose that bean export demand, we tend to start our corn loadout program. So we should start seeing some better corn export sales and shipments. Now, if that would start to heat up, that will definitely provide some support for the market, Jesse. A lot of people in the trade are anticipating China to be a little bit more aggressive buying U.S. corn. They have not been so far. They've been buying the Brazilian corn, which, remember, they just cut that deal to start buying Brazilian corn at the end of last year, and they're taking advantage of it. But that talk that China's going to have to buy some corn for the U.S. with that carryout dropping in the January report, I believe that's going to keep some support on this old crop corn, at least until we get a better handle of the Safrinha crop as well as our acres. So, I think what you're looking at in general, Jesse, is the market will find support down near the fall lows, roughly 45, 50 cents lower than where we are now. And then on the other hand, I think anytime you get over 7, I think you're going to find a lot of resistance, because I think there is a lot of grain sitting in the producer's hands. I think the producers need to sell corn when it gets up near 7. I'm going to encourage you to sell corn when it's up near 7, because the cost of money is so expensive this year. I think, you could probably sell it and re-own it on paper cheaper than you can keep it stored in your bin. So I think just in general, at least for the next 30, 35, 45 days, and maybe until at least the March acreage number, this corn market's going to trade more of a sideways range, kind of like we saw today. Beans are under pressure, but corn and wheat were trading higher after rebounding from yesterday's shellacking. So just that kind of volatile chop is probably the indication, at least for the next few weeks, for corn.
Well, and again, coming back to the acreage battle thought between, say, corn and wheat, looking at fertilizer prices, I know they're coming down, but one has to wonder, what these wheat markets could do, what acreage could look like on the wheat side as we get into the spring. I know the winter wheat crop, we have concerns about it in the Southern Plains still, but just thinking about that potential, looking at wheat right now, especially after Tuesday's close, feels like we're going to get pretty range bound here for a little while, Jim. I wonder what your thoughts are on wheat right now.
I think it's the same thing. I mean, the reality is we're going to wait and see how the spring weather materializes as we come out of dormancy. We know the Western wheat belt, the Kansas City wheat belt in that area has just taken it on the chin. They are starting to get some moisture. Is that too little, too late? We don't know. So that's going to keep a bid under the market. But on the other hand, we've got Australia has got a whopper of a crop coming online. Russia continues to try to sell wheat out of its country. So that's going to limit the wheat to the upside. And then in the big picture, where this wheat market's probably going to depend on is potentially the U.S. dollar. If the U.S. dollar weakens, that will allow us to get back into the wheat export game. But if the dollar would strengthen, that is just going to be one more hurdle the wheat market's going to face. So the wheat market, like I said, sideways near term, just like the corn. But as we come out of the spring dormancy, that's where it's going to get a little bit more challenging right now. I think one other note I do want to make now about the wheat, though, if you look at that winter wheat seedings report in January, a lot of winter wheat went in the Eastern Corn Belt. So what I think that does set us up, at least on the bean side of the equation, potentially could be adding a little bit of bearishness to the bean market is I think a lot of those acres, wheat acres, will be followed up by beans this year. And that's going to be some of the most profitable acres out there right now. So, if we do have a big, a decent wheat crop in the soft red wheat belt followed up with the beans, that's something we need to keep an eye on for the bean market in the long run as well.
That is a great point that you make there. Let's move over to livestock, Jim. Start with this cattle market. Cattle market on the day on Tuesday, mixed to lower, we'll call it here. Corn prices, wheat prices going back up, probably had an impact. But, as you look at cattle, that cattle on feed report we had last Friday, neutral, pretty much as expected. What's your thoughts with what's going on right now in this cattle trade as we look at things?
Right now, the cattle trade, there's the argument we're going to the cattle trade now. There's two different arguments right now. When you look at the cattle on feed numbers, you look at the overall inventory. The cattle herd is getting smaller. It's been getting smaller now for 4 years, and that is definitely a bullish argument. If you go out and look at the demand numbers, the supply numbers, the amount of beef we're going to produce in the U.S. side, it's hard not to get very, very bullish on that side of the equation. The real question is, what's limiting us right now from, I think, really getting aggressive on the cattle is the demand side. What we're seeing recently is the consumer is shying away from the expensive cuts. He's going to the cheaper cuts as inflation continues to take a bite. If the economy, the debt ceiling, as we mentioned, if that starts to kind of get people spooked, the demand may not be as strong as people think. And that could mute some of the supply issues we're talking about. The other thing I think you got to just keep an eye on, I know we bring in a lot of beef, from Canada, but if the world's economy slow down enough, we tend to be the dumping ground for beef, unfortunately. We'll get it from Australia. We'll get it from the Argentinians. And that could, it's not just the U.S. market. If the world traders can't get that protein sold to the Asians because they're struggling, we're going to end up with it. So that tight supply story that everyone in the industry is looking at, I'm a little bit cautious that it may not come to fruition. So just like the grain market, I'm going to encourage producers to buy puts under these livestock just as a way to hedge off this economic risk.
Well, and something as well that has been interesting is just the wide spread between cattle and hogs right now. This hog market, Jim, I've been sitting here wondering, have we found a bottom yet? Can we find some support? Can we bounce off of it? Thought maybe yesterday, Monday was the day. Not so much. We sold off again. So this hog market, what do you make of just what's going on here? It just feels very sluggish right now.
Well, you've said it best. Everyone's looking for the bottom of this hog market. I'm optimistic we're close. Essentially the hog protein, some of the cheapest protein in the market. I think it's even cheaper than eggs probably when you take it per pound due to the egg shortage out there. It's definitely it's cheaper than chicken. It's cheaper than beef. So the market is searching for some demand to kick in and find that price. We haven't seen it. If you look at the charts, we are massively oversold on all technical indicators. So if you can get any kind of a glimmer of hope that this market is starting to turn on the demand aspect of it, I think you could get at least some of a short covering rally. The China market, the reality is, Jesse, in the big picture, we ramped up production. China ramped up production. China stayed in COVID too long. Their hog prices have dropped 50% since the fall. So, the idea that China is going to come in and buy a lot of U.S. hogs to kind of solve our oversupply problem is not quite going to happen just yet. I do think China eventually is going to hopefully get a nice rebound. They're racing through COVID. They've gone from COVID 0 to COVID 1,000. At this point, I'd guess everybody in the country will have it by the end of February, and hopefully we get a nice COVID opening rebound like we saw in the Americas. In Europe, but right now the hogs are searching for that bottom. I think we're close, but no technical sign yet.
Well, Jim, before we wrap it up here today, floor is yours. I'll give you time for any final thoughts, anything else you want to mention we haven't covered, or anything you want to reiterate today.
Well, a couple things. First thing I am going to reiterate, we do have our conference coming up here, Jesse, in a couple of weeks down there in Nashville near you on February 6th and 7th. If anybody's interested in going, go to agmarket.net, hit the banner at the top. We'd be happy to have you out there and let you see what we have to say on a personal basis on the markets. I am just going to reiterate, now's the time to really crunch your numbers, find out your break evens, and do not be afraid to lock in profits this year. We have changed the game dramatically. I've been doing this for 28 years. The game's changed. The world's competition's there, but this dollar and what it could do is going to have a huge impact. And then just the cost of money. That is the one thing that people, I think, have got to take a serious approach. Storing grain this year, borrowing money this year, when you're looking at interest rates around 5, 6, 7, 8, 9%, that is going to have a huge impact on your balance sheet. It's something you're not used to doing. You've got to talk to your bankers about it, add in the higher interest rates, and make sure you come up with a marketing plan that guarantees you profits this year.
Well, and again, their conference coming up here in a couple of weeks in Nashville, all the details, and you can reach out to them as well. Contact them, agmarket.net, or you can give them a call, 844-4AGMARKET. Jim McCormick, always pleasure, sir. Thanks so much for the time, and we'll see you in a couple of weeks in Nashville.
Sounds good. Thank you, Jesse. Have a good day.
And that's going to do it for Market Talk here today. Find us online at markettalkag.com. I'm Jesse Allen. Have a great afternoon.